The beauty of NPS is its investment in diverse asset classes to generate optimum returns for the subscribers. NPS is a government-sponsored pension scheme which has been a game changer for retirement planning since its inception in 2004. We will explore everything you need to know about NPS investments. Let us start with some basics. NPS was introduced in the year 2004 for government employees and later opened to all sections in 2009. NPS offers a unique way to secure your retirement by investing the contributions in diverse asset classes. Under NPS, the subscriber contributes regularly to a pension account during their working life, withdraw part of the corpus in lump sum, and use the remaining corpus to buy an annuity for a regular retirement income. NPS offers a flexible choice of investment across 5 asset classes. Let us discuss each one. It offers default choice for government sector subscribers, auto and active choices for all subscribers. Pension funds appointed under NPS invest in the following 5 asset classes. The first asset class is government securities. These are regulated, guaranteed by central or state governments. It also includes mutual funds dedicated to government securities. Debt instruments includes various options like corporate bonds, Basel III Tier-1 bonds, Rupee Bonds issued by international institutions. Basel III Tier-1 bonds, often referred to as Basel III Tier-1 capital instruments, are a type of financial instrument used by banks to meet the capital requirements established under the Basel III framework, which is a global regulatory framework for banking supervision. Short-term debt instruments include money market instruments, term deposit receipts, and short-term debt mutual funds. Equities as an asset class include stocks of top 200 listed companies, equity mutual funds, and ETFs. Asset-backed securities or mortgage-based securities and units issued by real estate investment trust. In default choice for government sector, 65% is invested in GSEC and up to 45% in debt securities and up to 15% in equity. Under active choice, one can actively allocate into various asset classes. Let us discuss about each of the 5 asset classes one by one. Government securities offer a high level of security and are primarily backed by the government. These are bonds and securities issued by the government, and they are considered one of the safest investment options available because they come with a full backing and guarantee of the central or state government. The Government of India issues securities to raise capital for development projects issued by Reserve Bank of India. The RBI manages the public debt of the Indian government. Government of India fully serviced bonds issued by public sector undertakings under extra budgetary resources (EBR). This adds a layer of diversification to NPS portfolio while still maintaining the government backing. The Government of India is servicing the debt obligation on these bonds directly through budgetary allocation under a separate designated head. EBRs are borrowings made by the government-owned entities that are the debt of the government, known as extra budget borrowings or resources. These are also known as off-budget resources. Under GSEC, mutual funds set up as a dedicated fund for investment in the government securities which are regulated by SEBI. Let us discuss the next asset class, debt instruments. First and foremost, we have the opportunity to invest in listed debt securities issued by various body corporates, including banks and public finance institutions. These are essentially bonds and debentures offered by these entities to raise capital. Basel III Tier-1 bonds issued by the scheduled commercial banks under RBI guidelines. These bonds come with their own set of rules and guidelines which can provide a source of stable returns. Another noteworthy option is Rupee Bonds issued by institutions like International Bank for Reconstruction and Development, International Finance Corporation, and the Asian Development Bank. These bonds offer exposure to international financial institutions and its performance. Term deposit receipts issued by scheduled commercial banks are also part of this asset class. These banks should satisfy conditions like declaration of profit in the preceding 3 years and maintaining low non-performing assets, which add another layer of safety. Furthermore, Contributions are invested in the units of debt schemes of mutual funds regulated by SEBI. It is important to note that there are certain exclusions within this category. Debt instruments with a Macaulay duration of less than 1 year are excluded from this particular asset class. Macaulay duration measures the time taken by an investor to recover his invested money in a bond after taking into account the interest receipts and principal repayment. Debt securities issued by Real Estate Investment Trust (REIT) and Infrastructure Investment Trust (InvIT) are viable options for diversifying one's NPS portfolio. Additionally, this category encompasses various infrastructure-related debt instruments, including securities issued by the bodies involved in infrastructure development, construction, and affordable housing. It even includes securities issued by Indian Railways or government authorities focused on infrastructure development. To ensure prudent investing, there are specific guidelines regarding credit ratings. Investment in securities with at least AA rating from 2 SEBI-registered credit rating agencies are required. Investments in securities rated between AA- to A are permitted, but with a cap of 10% of the total debt instruments portfolio in the concerned scheme. Any instruments exceeding this limit should be covered with credit default swaps. For risk mitigation, credit default swap is a contract between two parties in which one party purchases protection from another party against the losses from the default of a borrower for a defined period of time. The next important asset class is short-term debt instruments and related investments, which are actually money market instruments comprising treasury bills, commercial paper, and certificate of deposits. These asset classes are essentially short-term financial instruments with high liquidity and low risk. However, when it comes to commercial paper that are issued by corporate entities, there is one important condition. Thus, these instruments must have a minimum rating of A1 plus from at least 2 credit rating agencies. TDRs, the term deposit receipts issued by scheduled commercial banks, are also part of this asset class. The units of debt scheme of mutual fund regulated by SEBI. The important catch here is that these investments should be in short-term securities with a Macaulay duration of less than 1 year. NPS offers opportunity to invest in government securities as a lender in tri-party repo conducted over tri-party repo dealing system or TREPS, which is provided by Reserve Bank of India through Clearing Corporation of India (CCIL). Tri-party repo is the repo or repurchase agreement, which is a financial transaction in which one party sells securities to another with an agreement to repurchase them at a specified future date and price. The tri in tri-party repo indicate that there are three parties involved in this agreement. One is the lender, then the borrower, and the neutral third-party agent, usually the clearing corporation, which facilitates and ensures the transaction is smoothly executed. We are diving deep into the world of equities and related investments within NPS. This asset class offers the potential for significant growth in your retirement portfolio, but also comes with its unique set of considerations and risks. It's a powerful option for those seeking higher returns and willing to navigate the dynamics of the stock market. So what exactly falls under this category? First, you have the opportunity to invest in shares of the body corporate listed on major stock exchanges like Bombay Stock Exchange or National Stock Exchange (NSE). These shares are carefully selected from the top 200 stocks in terms of full market capitalization. Full market capitalization represents the market value of all outstanding shares of the company's stock at a given point of time. Market capitalization is a fundamental indicator that provides insights into the company's relative size within the stock market. Additionally, you also invest in units of equity schemes of mutual funds. These mutual funds primarily invest in shares of listed companies, providing you with a diversification and professional management. Exchange traded funds and index funds regulated by SEBI that replicate the portfolio of particular indices like BSE Sensex Index or NSE Nifty 50 index are also part of this category. These funds offer a convenient way to gain exposure to the broader stock market. There are exchange-traded derivatives which use permissible listed stocks or indices as underlying assets for hedging purposes. It's a way to manage risk while participating in the equity market. And let us not also forget about IPOs, FPOs, and offer for sales. IPOs involve the initial sale of shares by a company when it is going public, whereas FPOs involve the sale of additional shares by an already publicly traded company, and OFs involve existing shareholders selling their holding to the public. These methods provide companies with opportunities to access capital markets and fund their growth and operations. It is also essential to keep in mind that while equities and related investments offer the potential for significant capital appreciation, they also come with market volatility and risk. Therefore, a balanced approach to asset allocation is the key. The asset-backed, trust-structured, and miscellaneous category provides the options that can complement overall investment strategy. First, you have the opportunity to invest in commercial mortgage-based securities or residential mortgage-based securities. These are financial instruments backed by mortgages on commercial or residential properties, offering a potential source of income. Another interesting option is units issued by Real Estate Investment Trust (REIT). REITs allow you to invest in income-generating real estate assets such as office buildings, shopping centers, and apartments, which provides a unique way to participate in the real estate market. The category also include asset-backed securities, which are regulated by SEBI. These securities are backed by a pool of underlying assets such as loans, leases, and receivables, which can offer both income and capital appreciation potential. Additionally, units of infrastructure investment trust, which invest in infrastructure assets like roads, bridges, and the power plants, allowing you to be a part of India's infrastructure growth story. It is important to note that investment under this category are required to have a minimum AA from at least 2 credit rating agencies, which ensures a certain level of creditworthiness and risk mitigation. Furthermore, for investments in REIT and InvIT, there are specific requirements for rating of the trust and also the sponsoring entity. While the asset-backed and trust-structured and miscellaneous category may have a smaller allocation in your NPS portfolio, it offers diversification benefits and the potential for income and growth from non-traditional assets. Thank you for watching Learn by Choice. Please subscribe to Learn by Choice for more and more videos.